So welcome everybody to this week's webinar regarding CFDs. Thank you for taking the time out of your busy schedule to be with us today. So after this webinar, what are the results we actually want you guys to take away? Firstly is to create awareness. You can take advantage of market volatility, do something about it, and plan better. And secondly, to provide options, make better informed decisions, better informed investment decisions, and do it with some peace of mind. As per normal, the webinar will be emailed out to the guys within 2 business days after the conclusion of the presentation. So guys, welcome from me. My name is Grant Mankies. I recently joined the PSG group, and I'll be the facilitator for today's CFD presentation. So firstly, to start with a nice quote, first ask yourself, what is the worst that can happen? Then prepare to accept it, then proceed to improve on the worst. So what is very important when you guys start trading CFDs is that you need to create or confirm what is your risk appetite. And what does it mean in layman's terms? How much are you willing to risk on every transaction? All right, guys. What is our current position? What is the current position in the world at the moment? Well, something that's very relevant at the moment is Brexit. Everybody's talking around it. Markets took heavy beatings on Friday after the UK guys voted to leave the European Union, down 4% on that Friday. Then Monday, another 2% down. Since then, we had some good recovery, but the last 2 days seems to have eased off again. We're down almost 2% again today. They're also talking in the world around continued stimulus. They're talking in the US around only raising rates the latter part of 2018. So what does that mean for us? Prolonged low interest rates in developed markets will drive investment to emerging markets with higher interest rates and higher yields. South Africa is one of those emerging markets, so we've seen through the currency that there's been a higher demand for the rand. So rand's trading at around 14.85 and the pound around 19 rand 5 cents. That pound level 19.05 is about the same level as a year ago. So it's the best level that South Africans have had an opportunity to maybe take some cash offshore if they need to do something like that. So what is the ideal position for any of us that want to start trading? We want the ability to participate in the market. We want to participate in falling markets. So we'll go through how you can participate in falling markets by going short the market through CFDs, and the ability to use geared products to diversify your portfolio. And at the end of the day, we want your money to start working for you. So how do we get there? One of the options are in the derivative markets are CFDs. And so let's go through some of the terminology. So a CFD is a derivative. What is a derivative? A derivative is a product that derives its value directly from the underlying share. Us at PSG, we offer CFDs only in the top 100 listed instruments. You might ask, why not on the full range? Well, a lot of those shares in the latter part, this 200 to 400 shares are very illiquid. So when we trade derivatives, we don't only want to get in, but we want to get out quite quickly and not cross big bid-offer spreads. Something that's important to remember on CFDs is initial margin. It is a minimum deposit required. I view it as a good faith deposit or collateral. When you start trading something and you want to buy something where you don't put up the full value thereof, people usually want collateral, and that collateral, that initial margin gets placed on deposit, and you earn interest on that margin at a SAFEX overnight rate, which is currently at 7.04%. When we talk about longs, it is meaning you're buying something, taking a view that the share price will increase. A short is taking a view that the share price will decrease and benefiting by the reducing of share price. Spot, we talk about spot, that is the price at which the underlying share trades at, where this derivative is going to get its value from. Mark to market is the physical revaluation of your portfolio on a day-to-day basis, and the variation margin is that actually flow where you have your portfolio increases or decreases. If your portfolio increases, you can use that increase in value to trade some more and add to your portfolio. Similarly, if your portfolio goes down, you'll have less money to transact with. When we have 2 margin bands within the business, and the reason for that is volatility. The top 40 shares are less volatile and very liquid compared to shares 60 to 100. So for a share in the top 40, we'll ask you 15% initial margin, and a share between 40 and 41 to 100 will ask you margin of 17.5%. Simple calculation there is if you're buying a 100 Rand share, we want 15 Rand margin. So the minimum cost or the minimum exposure we want you to take is 25,000 Rands worth of exposure, and that margin would then equate to 3,750 Rand on the top 40 and 4,300 Rand on share 41 to 100. Something important to remember, because you're trading a derivative, you're not trading the physical underlying share, you receive all distributions paid out by the company, but that distribution is seen as a synthetic dividend, and for tax purposes will be treated as income. And because you're a holder of a derivative, not the underlying share, you cannot go to the AGM and vote. You can't ask for a letter of representation either, because you are not the physical shareholder. Now let's look at an example between a share trader and a CFD trader, both having exactly the same thought around a specific share. In this case it's Sasol. So investor 1 who trades shares, she wants to invest 40,000 Rand into Sasol, which means at a share price of 400 Rand, we can buy 100 shares and have exposure to 40,000 Rands worth of Sasols. 3 months later, the share has gained 10%, and when you sell it at 440 Rand, you will make 4,000 Rand profit, or a 10% return on investment, which isn't bad for this period. So now a CFD trader has the same thought process, wants to buy 40,000 Rands worth of exposure on Sasol, but that means he only has to buy 100 CFD contracts and only put up 15% margin to get the same exposure, which equates to 6,000 Rand. After 3 months, the share is at the same level, 440 Rand, and makes the same profit. But what is important to note that on a CFD, you don't make more money than on the share, but your percentage return on investment is a lot higher. In this case, you made 66% return. How do we get to that number? You say your profit divided by the margin placed on deposit. Something important to note is if you're going to trade CFDs, and if you're starting out to trade CFDs, stick to the exposure you were going to buy on the underlying share. When we talk in derivative terms, we talk about the kind of gearing and the exposure that you're going to take. So if you over gear yourself, it means you're going to take this 40,000 Rand that you actually have and go and buy 40,000 Rands worth of margin into Sasol, which probably means that you're over gearing yourself 6 times. On the plus side, you'll make 6 times the amount of money you would have made with the 40,000 Rand on the equity, but if the market goes down, you'll lose 6 times more than you would have made or lost on the underlying share for the same period. So let's just look at some more examples. If I'm looking to buy a CFD on Anglo American and the current share price is at 121 Rand, I have a target price of 148 Rand and a stop loss at 114 Rand. What is important to note when you guys transact in CFDs, like I said right at the start, have your risk profile assessed by yourself. How much am I willing to lose per trade? What we need to do as derivative traders, we have to remove emotion out of trading. So say to myself, I'm willing to take a loss of 7 Rand per share in this example. What is my reward? I'm doing some technical analysis, as you can see on the right-hand side, that I'm expecting the share to go up to a target price of 148 Rand, which means I have a potential reward of 27 Rand per CFD when the share price has moved 22%, but my geared return would then be 148% because I'm only going to put up 15% of the 121 Rand, which is about 18 Rand 15 cents per share, instead of the full 121 Rand per share. And when we talk about shorting is a term that is pretty new for anybody who trades derivatives. In layman's terms, it's something you're selling that you don't own. In this case, you're selling Truist because you think Truist is overvalued. Everybody has stopped buying clothes from the Truist retailer. Rising interest rates has forced people to have bad debts with the retailer. So we think at current valuations of 109 Rand, it is overvalued, and I think it's going to drop to a target price of 98 Rand. And my stop loss that I'm going to put in is 112 Rand 60 cents. It's important to note that when you're going short, your stop loss should be above the current price that where you're entering. Remember, you lose money on a short if the share price rises. So I'm willing to take a 3 Rand 60 cents risk on the share. My reward, I'm hoping for the share to drop by 11 Rand per share. So I have a potential reward in terms of the share of 10%, but my geared return would then be 67% on the cash that I'm investing, which should be around 16 Rand odd, based off 109 Rand share price. So now let's look at some of the associated costs when trading CFDs. So if I'm going to buy 286 Anglo shares in my long example at a price of 121 Rand, so 15% margin would be 5,190 Rand, so my exposure is going to be 34,000 Rand. Cost of trading CFDs through the organization is 40 basis points or 0.4% on the notional. So 34,606 Rand times 0.4% would give you 138 Rand 42 cents. Add a VAT on top of that, of course, and you get a total in price of 157 Rand 80 cents. When the shares reach my target price of 44 Rand or 148 Rand, which means I'll sell it and get an exposure of 44,000 Rand, the brokerage then would be calculated on the new notional, and therefore you can see the cost of transaction is slightly higher than the in price. Now we look at my profit. On that transaction, I would make 8,100 Rand, and as a geared return percentage would be 149%. So let's look at the SASL again. So we sell first, so we go short at 109 Rand. The initial margin, because it's a bigger position, would be 9,800 Rand, and my exposure would be 65,000 Rand, 65,400 Rand. Cost of transaction, as I explained. But look at the bottom, my geared return on my investment is 61.5%. Remember, the percentage gain is bigger because you're putting up less capital to trade the transaction, but the Rand value will not be higher than what you could have made on the share. All right. What will this do for you? So what are the features and benefits of trading CFDs? It is very capital efficient. You have low trading costs. Short positions, you have the ability to trade something short or short the market or short the sector if you feel it's overvalued, and it gives you the ability to hedge your portfolios. So when we talk about hedging, you think I have a long equity portfolio at the moment, and I think certain shares in that portfolio is overvalued, but I don't want to sell it. I'm still buying into the long-term view of the share, but in the short term, I want to ensure that I don't want to lose money. So what I will do is then short the individual share, and then whenever the share price starts correcting, I will buy back the short and close out that position. So I've really made some money on the negative movement on the share. What you should also think about when shorting shares or shorting individual stocks should be a short-term trading strategy. As we all know, over time, the market has returned 16+% compound growth. So you don't want to be left on the short side continuously. When we talk about direct market access, it means this price you see on the CFD quotes page, when you buy and sell the CFD, the bid and offer price there is exactly the price of the underlying share. The organization or us as PSG do not take a spread on top of that and then charge you 40 basis points commission. You can place trades after hours, like most of the people attending this presentation today or this webinar. You have day jobs. You cannot sit in front of a trading screen like I have the fortune of doing on a day-to-day basis. What you would do is you will analyze your portfolio at the end of the day, place your buying and selling orders that you want to get into or out of, and when the market opens the next morning, we'll put those into the market as the market opens at 9 o'clock and closes at 5 o'clock. Price transparency is very important. If for any of those of you who've traded single stock futures, there's always this cost of carry component that is included in the future price. On a CFD, the price you pay or the price you see is the price you pay. All the associated costs are seen as separate line items. As per shares, you can place price alerts and stop losses. So as you know, whenever a share price hits a certain level, it can either send you an SMS or an email. And very importantly, the ability to place stop losses, because we don't want to be left in a position where you continuously lose money because you're out in a meeting or you're out in an area where you cannot access the internet. One of the costs of trading short CFDs is a scrip lending fee. What that means in layman's terms is for us giving you the ability to sell something you don't own, we have to go and borrow that underlying share in the market, and that 1.5% scrip lending fee is per annum. So you only pay for what you use. So if you've used 2 days worth of scrip lending fee, it will be 1.5% on the notional that you short, divided by 365 days in the year times 2 days will be your scrip lending fee for that period. Interest is payable, so interest is payable on the long position. Why is the interest payable? Think about what do we do as the market maker or the provider of this product. You buy a CFD and you only give me 15% collateral. For me to give you the performance of this CFD, we have to go out and buy the underlying share. So we'll long the stock, long the share, and short cash. So there's a loan component attributable to that loan, and we pass that loan component onto the buyer of the CFD. And at current levels, I think it is prime less 1. So if you're long CFDs, you pay prime less 1% per annum and then calculate it accrued daily, capitalized monthly. If you go short, the opposite is true as well. You sell something you don't own, so we raise capital, and that interest is then paid to you on the short position at the SAFEX overnight rate, I think, minus 1%. And then on the margin, like I said, you earn interest on the margin that you place on collateral, and that margin, you'll continuously earn interest on that margin until you close out the position and the margin is returned back to your account. You receive synthetic dividends. So the nice thing about this is you don't lose money when the market goes down because you'll get the cash flow back from the synthetic dividend, but you'll have to pay income tax on the interest that you've received or the synthetic dividend. But as we're dealing with a trading product, you're definitely not going to be falling into the capital gains tax territory, but you're definitely be falling into trading income tax section, so you will be paying a higher level of interest. As a derivative holder, you don't have any voting rights, and one of the big risk warnings I have to put out there, you have the risk, if you do not put on stop losses, that you can lose more than your initial margin. So if you think about it, if you have a 100 Rand share, and the share goes from 100 Rand to 50 Rand overnight due to some adverse, news that comes out, you can lose 50 Rand per share, or 50 Rand per CFD, although you've only given me 15 Rands worth of margin. And those sort of things is the next morning we'll deal as a margin call, where you'll have to top up because you're in debt to the business. Some of the considerations when you compare single stock futures to CFDs. So single stock futures are traded on the JSE, the South African Futures Exchange, and is regulated by the Financial Services Board. CFDs are traded with PSG. So your risk is with PSG, and your risk is that PSG cannot fulfill its commitment to settle variation margin to you as and when it's due. The difference on single stock futures, you pay 60 Rand booking fees. There's no booking fees on CFDs. Scrip lending fees, you do not pay the 1.5% as a line item on single stock futures, but you have to consider that it will be priced into the futures price. You don't see it as a line item. On the CFDs, because of the price transparency and all that, you'll see the separate line item. One of the downfalls for single stock futures, unfortunately, is that you have futures expiries. These happen on the third Thursday of March, June, September, and December. And on a CFD, because it's a perpetual instrument, you do not have any rollovers, so there's a nice saving in some fees there for you. Both of them attract some wholesale interest rates. Both of them have synthetic dividends. And then on the single stock future, you have the ability, so with like an option, you have the right but no obligation to take up delivery. And on CFDs, there's no ability to take up the share, underlying share, because it's not embedded in the contract how it was designed. From my experience on single stock futures, any retail investor that trades single stock futures, 99.9% of them never take up the underlying share. They use it as a trading instrument. And like I said, there's no obligation from you, the buyer of the single stock future, to take it up. So some factors that we need to consider when trading derivatives. We need to consider what our trading account size is. How much exposure am I going to take on any transaction? How much am I willing to risk? How much time can I dedicate to trading? So when you're trading outright equities, you have the ability to every night analyze your portfolio for 10 minutes. When you're trading derivatives, because it's realized P&L every single day and flows through your account, I would suggest that you spend slightly more time on trading derivatives. What is your level of experience? So you could be a novice investor in the CFD land, but you could be an expert in the sector. So if we think about, we're in the financial sector, so I'm a financial sector expert. You might be in the retail sector, or in the construction sector, or the resources sector. So play to your strengths. Play shares that you know, either the company that you work at or companies that are relevant to the sector that you or market that you're trading and have lots of experience on. Your risk tolerance, how much money are you willing to lose at every transaction? Us as human beings, we don't like losing money, but we have, it's unfortunately a reality in trading the stock market. How much money do I want to risk in this transaction? Remove the emotion out of trading. Try and at least remove the emotion out of trading. And when trading derivatives, we have to stick to our stop losses. That is the one most important thing when you trade derivatives. If you do not have the ability to sit in front of a screen the entire day, a stop loss is going to save you. And the reason you put a stop loss in is because you had a risk assessment. When the market closes you out or your stop loss is triggered, do not get back into the market straight away. I have years of experience in terms of this. The market, you've put a stop loss in, the market is reacting to something specifically. When the market changes, you need to change. So go and look at what's happened in that specific share. Is it related to the market, or is it related to just an underlying issue within the company? And when the market changes, you need to change your trading activity. If you see there's something really negative around the share, go short the share and participate in the downside and make some money back after you got closed out. Are there any questions from the audience at this point in time? I'm not seeing any questions coming through. If you have any questions, just type it into the communication, and I'll try and address them in the next couple of minutes as we continue with the presentation. In conclusion, we know a CFD is a geared product. What are the characteristics of a geared product? You have to put up initial margin to trade it, so your collateral and variation margin. Variation margin is the daily realization of P&L, increasing and decreasing of your portfolio. You have the ability to be capital efficient. What I like about derivatives, it gives you the ability to diversify your portfolio. For example, if I wanted to trade, in our examples, we showed Sasol, we showed Anglos, and we showed Truitt's. And with 40,000 Rand, I would have been able to trade all three of those instruments and get exposure to the market. So I'm diversifying my portfolio, and they have low trading costs. At 40 basis points per transaction is lower than getting into the market in the underlying equity space. What are the next steps? So I encourage you to go and read up about CFDs on our website. You can have access to our private client traders, Given and Tian, on that number. If you need any additional information regarding the product, you can drop our client services an email or contact them on their direct line. And if you need any information from me, the upcoming webinars for the next month has been published, the 13th, 20th, and 27th of July. How to protect your offshore allowance. Are you invested correctly, and are you tax-free? And as I said in the beginning, my name is Grant Mainkies. There's my contact details and the contact number that you guys can get a hold of me. And thank you very much, guys, for taking this time. And I hope you all have learned something new about derivatives and specifically to CFDs today. Are there any questions? Because we do have a couple of minutes before the webinar ends. All right, guys, I don't see anybody sending through any questions for me today, so I hope you guys understood everything that I was speaking about. Good luck trading CFDs. I'm sure you'll all be very successful in trading it. Thank you very much for your time today, guys, and enjoy the rest of your day. Thanks, bye.